Welcome to the Deep Dive, where we take the latest news and earnings calls and turn them into actionable insights for you. Today, we are deep diving into the Q3 2025 earnings for Biogen, ticker BIIB. And this was one of the most confusing earnings reports we've seen all quarter, delivering a massive beat on revenue and profit, but simultaneously giving us a surprising and a material cut to their full-year profit guidance.
That's the core tension right there. If you watch the stock reaction, it dipped sharply pre-market on the guidance news, then spent the rest of the day recovering to close up slightly. It tells you the market was fundamentally confused.
Right.
This is not a simple operational success story. It's, a classic biotech pivot.
Yeah.
They proved they still have exceptional operational strength in their legacy franchises, but they are meeting that cash generation with a strategic, deliberate, and frankly expensive reinvestment into future growth.
Okay, let's unpack this central contradiction. Our mission today is twofold. First, we need to dissect exactly why management chose to lower the profit forecast despite delivering such a strong operational beat. And second, we need to analyze the real progress of their key growth drivers, specifically Laquembee, and their aggressive push to build out a complex immunology pipeline. Let's start with the operational snapshot, because the numbers themselves were undeniably excellent. Revenue landed right around $2.54 billion, which materially exceeded the street's consensus of $2.34 billion.
Crushed it.
That represented a respectable 3% year-over-year growth. And non-GAAP EPS came in at $4.81. I mean, that is significantly above the $3.88 consensus estimate. By the headline metrics, this was a fantastic quarter.
It was a powerhouse quarter on the operational side, but here's where the confusion came in. Immediately following those strong numbers, the company slashed its full-year 2025 adjusted EPS outlook.
A full dollar, right?
A full dollar. They brought the range down to $14, $15 from the previous $15, $16 range. They did, however, modestly raise their full-year sales outlook, suggesting flat to plus 1% growth on a constant currency basis.
So, if they are making more money now and raising the sales forecast forward, what gives? You have to ask.
Yeah.
How can management justify delivering such an impressive quarter, generating all that cash, only to immediately lower the forward profit forecast? This is the conflict the market is grappling with.
And the short answer is capital allocation. This is a story of choice. The immediate strength you see comes from the resilient foundation of their core neurology franchises.
IMS drugs.
Exactly. Their multiple sclerosis drugs were robust, bringing in $1.06 billion for the quarter. Tysabri was strong, but critically, we saw the continued resilient performance of Vumerity, which has delivered nearly $500 million in sales just through the first 9 months of the year.
That core engine is humming. And it's not just stable, it's also fueling the future. The cumulative revenue from the new launch products actually grew 67% year over year.
Which is a huge number.
It is. What's fascinating is that this new growth has now more than offset the year-to-date decline in the legacy MS portfolio. They've reached a true inflection point.
And that operational success translated directly into exceptional free cash flow. They generated approximately $1.23 billion in free cash flow just in Q3.
Just in one quarter.
Just one quarter. When you look at their balance sheet, they ended the quarter with about $4.0 billion in cash and marketable securities and net debt sitting comfortably at $2.3 billion. That financial flexibility is massive. It's the engine that allows them to make these big strategic bets.
But let's be a little skeptical for a moment. If they already have $4 billion in cash, is it truly discipline to intentionally cut near-term profit guidance for new acquisitions? That seems like sacrificing today's certainty for tomorrow's possibility.
It absolutely is a near-term sacrifice, and management made it very clear that it was intentional. They are using that FCF to intentionally take a massive hit to the near-term profit and loss statement, or P&L.
So this was a choice.
A direct choice. The sole reason for the Q4 EPS guidance cut is a projected R&D charge of approximately $1.25 per share. This charge is directly tied to the accounting requirements of the business development transactions they expect to close in the fourth quarter. It's an investment, not a failure of sales execution.
And we know exactly which deals are driving this charge, which helps us understand the direction they are moving. They identified the license agreement with Vancouver Bio, which is bringing in a C5aR1 antagonist. Now, for listeners who aren't in the deeply technical weeds, a C5aR1 antagonist is essentially a molecule designed to quiet down a specific overactive part of the immune system that immediately expands their immunology footprint.
Precisely. They also highlighted the acquisition of Therapeutics, which bolsters their platform for ASO technology.
Yes.
Antisense oligonucleotide. In simple terms, this is a technology that uses short synthetic strands of nucleic acid to block the production of harmful disease-causing proteins. So these are foundational bets. They are not buying a phase 3 drug. They are buying core technological capability and early pipeline assets.
And here's where the strategy becomes truly aggressive, though. Management conveyed a very aggressive intention to target, quote, 1, if not 2, additional research stage deals before the end of the year.
So they're not done.
Not even close. This isn't just filling a gap. This signals an all-out, hyper-aggressive push to rapidly build out the early-stage pipeline, leveraging the cash flow from the legacy assets to buy optionality for the next decade. Now let's pivot to the product launches, starting with the headline maker. Laquembee for Alzheimer's disease. Global sales came in at $121 million, with $69 million in the U.S.
Which, on the surface, might feel a little soft.
It might. While the street might have expected a slightly higher number, that perceived softness requires critical context, and that's the China inventory dynamic.
Exactly. This is an accounting issue, not a demand issue. In Q2, the company built up a significant $35 million inventory in China, representing about 6 months of regional demand. As anticipated, approximately half of that build was drawn down in Q3.
So the sales were made, they just weren't recognized this quarter.
Right. What that means for the financial report is that negligible sales were recognized from China this quarter, creating a temporary headwind in the headline number, but sequential global demand growth remains strong.
The real game changer for scaling Laquembee is solving the capacity bottleneck. Right now, it requires infusion centers, which are sparse. The true strategic solution is the subcutaneous formulation.
That August approval of the weekly SC injection for maintenance is huge. It offers an at-home injection option, effectively bypassing the need for an infusion site once the patient is stable on the medication.
Which is everything.
It's absolutely critical for widening access and allowing the company to target the newly diagnosed patients who previously couldn't find a local center with capacity.
And the timeline for full access is something you need to keep your eye on. Teams are currently working through non-formulary exemptions. We are talking about a gradual ramp, but management is targeting full Medicare Part D coverage for this maintenance indication by 2027.
So still a ways off for full coverage.
A few years out, but it's a meaningful long-term driver for adoption.
The other capacity accelerator, which is often overlooked in the financial press, is the diagnostic pathway. We've discussed before how blood-based biomarkers are radically simplifying the early diagnosis process, making the care pathway much smoother for physicians.
How much smoother?
Well, they anticipate up to 350,000 Alzheimer's blood tests being administered this year alone.
What's the implication of that? Are those blood tests accurate enough to change treatment?
They don't replace the definitive scan yet, but they succeed as a triage tool. We are already seeing a massive 75% increase in PD scans compared to last year. More importantly, the data shows that the positivity rates, the percentage of people whose PE or CSF confirmation scans confirm they have Alzheimer's and are eligible for Laquembee, are increasing dramatically.
It is more efficient.
Exactly. The blood test is successfully ensuring that they aren't wasting the time and money on a costly scan for patients who aren't eligible, which increases the efficiency of the entire system and helps build treatment capacity faster than previously imagined.
Moving quickly to the rest of the growth portfolio, Skyclarys, their rare disease drug, showed continued patient growth. However, U.S. revenues took an approximately $6 million adjustment related to channel mix changes.
And that's the IRA.
Right. That's the IRA. The reason for this: the pricing and regulatory shifts linked to the IRA's Medicare redesign are causing turbulence in how drug channels are structured and paid in the near term.
Despite that noise, the core operational execution seems solid. Discontinuation rates are declining because they are doing better patient education, and they are successfully penetrating the community setting, which is where 2/3 of new patients are coming from first-time writers.
Which is a great sign of physician confidence.
It is.
Then there's Zurzuvae for postpartum depression. This is a true story of market creation, not market capture. It saw a huge 150% year-over-year revenue growth. They are reporting that 80% of prescriptions are being written as first-line therapy.
That statistic, 80% first line, is huge. It shows that in a condition like postpartum depression, which was previously undertreated or treated with repurposed existing medications, physicians are jumping on Zurzuvae as the preferred specialized treatment. They are essentially establishing a completely new treatment standard, which validates their commercial strategy in complex, nascent areas.
Looking at the broader pipeline conviction, the CEO emphasized they have 10 phase 3 or phase 3 ready programs currently underway. We saw key acceleration with lifelimab studies for lupus. The enrollment is complete, pulling forward both TOPAZ-E phase 3 readouts to the second half of 2026.
And that fast enrollment is a good sign.
Management views this fast enrollment in a competitive area as a strong signal of physician conviction and hopefully commercial success down the line.
If we connect this to the bigger picture, management sees the company as having always been in immunology, leveraging their deep MS experience to understand complex autoimmune disease. But now they're making a focused and aggressive push into rare and complex immunology, evidenced by deals like the C5AR1 antagonist.
It's a clear strategic bet.
It is a bet on long-term portfolio diversification. They are leveraging existing expertise to enter adjacent high-margin therapeutic areas. So to summarize the Q3 narrative, this quarter was defined by a critical prioritization decision. It was a conscious choice to sacrifice near-term P&L, that $1.25 per share EPS reduction, to secure medium-term growth optionality via external innovation and aggressive pipeline bets.
This marks a real inflection point for the company. The multi-year phase dedicated to the internal cost reset is clearly over. The leadership team is now transitioning the narrative into a new era focused heavily on launch execution plus external innovation.
And they're using the cash to do it.
They are using the reliable cash flows from their legacy assets to aggressively scale Laquembee and build that crucial layer of early-stage optionality through these external deals.
And importantly, their timing seems opportune. They are making these big moves while external tailwinds are starting to strengthen. Biotech sentiment is showing an early rebound after a multi-year lag, which supports M&A valuations and makes this aggressive business development schedule timely and sensible.
This is not financial advice.
Absolutely. But we always pitch an outrageous but plausible trade idea to our hypothetical investment committee based on the underlying analysis.
So what's the pitch?
The company is generating $1.2 billion in quarterly free cash flow. They are laser-focused on business development, and the EPS cut is a temporary intentional accounting charge, a calculated investment.
So if the market is mispricing this intentional sacrifice, how do we capitalize on it? What's the trade?
The trade is a long position on BIB via long-dated call options looking 12 to 18 months out, betting on a major 2026 re-rating.
And the rationale?
The market is ignoring the underlying $1.2 billion FCF and the immediate optionality of the Vanqua and Elshin deals. We are betting that the primary plausible catalyst is the accelerated litiflimab phase 3 readout in the second half of 2026.
And what's the outrageous angle that brings this all together?
The outrageous angle is leveraging that exceptionally strong cash position, the $4 billion in cash plus the massive FCF, to announce a third surprise high-conviction deal early in Q1 2026.
A third deal on top of the two they're already planning.
Exactly. This deal would target a significant mid-stage rare disease asset, one that the market hasn't factored into the company's current balance sheet capacity. It's a bet that the business development team will continue to outrun expectations and fundamentally re-rate the long-term growth profile before the end of next year.
Okay, let's wrap up this deep dive with the 3 core takeaways for you to remember. First, Biogen delivered a strong operational beat, but the headline success was intentionally overshadowed by deliberate, non-demand-related R&D investment charges.
Number 2.
Second, Laquembee's path to true scale relies fundamentally on the weekly subcutaneous maintenance formulation and the mass adoption of simplified blood-based biomarkers for triaging patients.
And third, the strategic commitment to building the immunology and early-stage pipeline is non-negotiable. Management is prioritizing future growth optionality by sacrificing near-term profits, transitioning the company from a cost reset story to an external innovation story.
Here's a final provocative thought for you to consider. Given the tremendous capacity constraints currently holding back Alzheimer's treatment globally, what happens to the entire sector's valuation if Laquembee's subcutaneous launch successfully proves that patient care capacity is indeed flexible and highly scalable?
If that capacity constraint breaks down, the market might be forced to price in the massive asymptomatic Alzheimer's disease population much faster than anyone is expecting today. That's the true upside risk, something to mull over as you track this name.
We'll catch you on the next deep dive.